Q4 FY23 earnings conference call hosted by Axis Capital Limited. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Jitendra Shi from Axis Capital. Thank you, and over to you, sir.
Thank you, Tanvi. On behalf of Axis Capital, I am pleased to welcome everyone to the Borosil Renewables Q4 and FY23 earnings conference call. We have with us the management team of Borosil Renewables, represented by Mr. P.K. Kheruka, Executive Chairman, Mr. Ashok Jain, Whole-time Director, Mr. Sunil Roongta, Chief Financial Officer, and Mr. Swapnil Walmich, Head of Marketing. We will begin with the opening remarks from the management, followed by a Q&A session. Thank you, and over to you, sir.
Good afternoon, and welcome to the Borosil Renewables FY23 investor call. The board of Borosil Renewables on 24th May approved the company's financial results for the financial year 23 and quarter 4 of the financial year 23. Our results and an updated presentation have been sent to the stock exchanges and have also been uploaded on the company's website. We will discuss the operation of Borosil Renewables on a standalone basis as well as on consolidated basis. I will also provide you some highlights of the operations in our newly formed acquired overseas subsidiaries. During financial year 23, the company recorded a net revenue from operations of Indian rupees 688.17 crores, an increase of 6.8% over financial year 22. Sales volumes on a quantitative basis grew by 4.3% as a result of commissioning of new plant, i.e. SG3, from 23rd February 2023. Average selling prices during the year were about 136.5 rupees per millimeter as compared to 133.5 rupees per millimeter in financial year 22, an increase of 2.3%. Export sales during financial year 23, including to customers in SEZ, were rupees 195.25 crores, comprising 28.4% of the turnover, an increase of 14.2% over financial year 22, when it had been 171 crores. While direct exports were Indian rupees 181.07 crores, which were up from 127 crores in financial year 22. During the last quarter of financial year 23, the company recorded a net sales of rupees 187.54 crores. From a quantitative standpoint, sales volumes were 7.8% higher than those for quarter 4 financial year 22. However, the average ex-factory selling price was lower by about 1.4%. The domestic selling prices were depressed for most of the second half of the year as a result of dumping from China, Malaysia, Vietnam. The landed cost of imports became lower due to a combination of two factors. Firstly, the expiry in August 2022 of anti-dumping duty on solar glass imports from China imposed in August 2017, coupled with a significant drop in international freight rates. Meanwhile, the price of natural gas, soda ash, packing materials and other commodities had risen considerably. All these factors contributed to a contraction in margins. EBITDA during financial year 23, including subsidies of rupees 9.75 crores from the government of Gujarat, was Indian rupees 176.55 crores, corresponding to an EBITDA margin of 25.7%, which was a steep decline as compared to an EBITDA margin of 41.1% in financial year 22. During quarter 4 of financial year 23, the EBITDA was at 38.02 crores and the margin was 20.3% as against 34.9% in the corresponding quarter in financial year 22 and 26.7% in quarter 3 financial year 23. Arising from increased costs coupled with lower selling prices, which prevailed during this period. Moreover, during this quarter, SG3 had been lit up and fully manned. As such, all expenses were being incurred while there was little corresponding revenue. Lower EBITDA led to a decline in the profit after tax, and the company recorded a profit after tax of 88.54 crore rupees, a decrease of 47% over financial year 22. PAT during quarter 4 financial year 23 was Indian rupees 11.69 crores, which is a decline of 75% as compared to quarter 4 financial year 22, which had better sales prices. Ironically, solar glass is the only component in the entire solar photovoltaic value chain which has no import duties whatsoever. With the expiry of anti-dumping duty on imports of solar glass from China post 17th August 2022, imports continue to remain completely exempt from payment of any sort of import duty. While imports are subject to a basic levy of customs duty of 15%, circular going back to 1999 exempts imports of solar components from payment of customs duty. This is an anachronism, not only because solar glass manufacturing is the most capital intensive component after solar cell, having the lowest asset turnover ratio, but also because an investigation launched by the Ministry of Commerce as recently as 2022 has found the largest solar glass manufacturers guilty of unfair trade practices, that is to say dumping, and have recommended imposition of 63% anti-dumping duty on imports from them. The odds are seriously skewed against the solar glass industry, where imports of heavily subsidized Chinese glass are welcomed into India with no imposition of any duties. There is no level playing field for this industry. We have been representing our case to the government rigorously to end forthwith the exemption from BCD on imports of solar glass. The solar installations in FY23 stood at a slightly lower 12.8 gigawatts in FY23 against 13.9 gigawatts in FY22. However, overall domestic demand for solar glass has become stronger as demand for Indian-made modules has risen strongly in export markets like USA, together with strong demand in India. The additional demand for glass is being met through higher imports owing to limited availability of domestic manufacturing capacity, and hence the market share of Borosil Renewables in domestic market currently stood at 19% only in the last quarter of the last year. The overall demand situation for solar glass continues to look robust in India as the domestic module manufacturing capacities are expected to rise to almost 100 gigawatts in the next 2 or 3 years from about 35 gigawatts currently. The actual domestic manufacturing may rise to 35-40 gigawatts annually, which will increase the demand to 3 times from the present levels over the next 2 or 3 years. Commissioning of a 10 megawatt captive power plant of solar plus wind energy being set up through an SPV in which Borosil has 31% shareholding, which was planned in December 22, was delayed due to delay in approvals from the relevant state authorities. I am happy to share with you that the requisite approvals have now been obtained and the project is commissioned. This is expected to meet about 35% of the company's power demand. This has enabled us to increase the use of green power in our manufacturing while also reducing the average cost of power. We are also looking to set up an additional 8 megawatts of solar plus wind power once there is enough clarity on the regulations. I am happy to share that commercial production from our third furnace SG3 began from 23rd February 2023, taking the production capacity to 1000 tons per day, 6 gigawatts, from 450 tons per day, 2.8 gigawatts. Going forward, we shall now be in a position to more than double the sales, servicing a higher customer demand while achieving higher operating leverages. The demand for glass has shifted to higher sizes. where we now have achieved capability. About 55 to 60% of the production is already in large sizes. We have recently commissioned facilities to service a higher volume of 2 mm bag glass with holes drilled and also grid printed. These are used for as bag glass in bifacial solar PV modules and has become a major growth area. The recently acquired German solar glass manufacturing plant had added an operating capacity of 300 tons per day to BRL's manufacturing capacity. The plant had been operating at about 95% capacity. However, a cold repair of this furnace was carried out from 13th March to 5th May, and the furnace has been brought back into production from 8th May. With a higher capacity of 350 tons, after incorporating changes which will help raise the production yield and achieve energy savings. A portion of the capex plan for the processing area is still under implementation, which will help achieve capability to supply larger size glasses and also enable more efficient operations. An overall capex of 34 million euros will be incurred on this, of which euro 24 million is being borrowed from banks. Now I come to the consolidated results for the quarter, which is the first full quarter post-acquisition. These results include the operations of the wholly owned subsidiaries abroad. The Interfloat Group registered a revenue of 121.79 crores in this quarter with an EBITDA of rupees 5.12 crores, registering an EBITDA margin of 4.2%. The subsidiaries have been able to achieve this despite prohibitively high energy and raw material prices and also shutdown of production from 13 March 2023. The consolidated net revenue and EBITDA for the quarter 4 financial year 23 stands at rupees 309.05 crores and rupees 39.08 crores respectively. The energy prices have been correcting gradually. However, on the other hand, the sales prices have been adjusted downwards in order to maintain competitiveness with the imports. With an emphasis on domestic manufacturing and sourcing from second force in European Union, USA and Turkey, we see export demand from our Indian operations rising significantly over the next 2-3 years. We believe that with manufacturing operations in Europe and in India, we are in a strategically advantageous position to meet higher demand in the export markets. With that, I would now like to open the floor to questions that you may have.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, you may enter star and 1 to ask a question. We will wait for a moment while the question queue assembles. First question is from the line of Keval Sahar from DSP Investments. Please go ahead.
Good afternoon, sir, and thanks for the opportunity. Sir, first question is that since we have 1000 TPD of capacity right now, and we can cater to 6 gigawatt of solar module capacity, and India in the next 2 to 3 years will have 100 plus gigawatts of solar module manufacturing capacity. So does this give us comfort that our current capacity and upcoming 1100 tons per day of capacity can be sold off in domestic market itself?
Yes, gives us a lot of comfort, provided the government does not make any further changes in its policy for solar modules in India. Okay, sir, got it.
So the second question is that over the last 2 years, if I see the realizations of solar glass has almost been stable, like at around 130 rupees. But our margins have significantly corrected. So is it because of elimination of BCD or the duties, or what is the reason our margins have corrected while the realizations have stayed the same?
See, the cost of inputs has gone up significantly, nearly by 60-70% in the last calendar year. And on the other side, of course, selling prices did decline because of the absence of any anti-dumping duty with effect from August of 2017.
2022.
2022. So what we see here is actually an overall price which is spreading over a long period of time. We had certain contracts at older prices and so on which got executed at those prices. So for all these various reasons, we see that the prices was a bit higher, but then they did register a decline in the last quarter.
Okay, sir, got it. So, sir, what would be the current realizations of solar glass?
So it's slightly lower.
Okay, sir. If you can give a number.
It wouldn't be right to put any number as of now, but it's slightly lower.
Okay, got it. Sir, what is the capex that we are planning for FY24-25, India plus Europe?
We just completed our capex in Europe. We spent about a significant amount of money there to rebuild our furnace, and it's now, as I mentioned in my talk, it's about 350 tons a day now, from 300 tons a day. And the furnace is good for another 5 years at least. So we've spent money there, and of course we spend money here. So at the moment, I do not see any special capex going in during the current year other than routine maintenance capex.
Got it, sir. So actually for the next year, the 1100 tons per day of capacity we are planning in calendar year 25.
Yeah.
So how much capex would be required for that?
So we are taking a pause as of now because we have just completed a large expansion. From 450 tons, we have moved to 1350 tons. So we will be reviewing this in the next quarters and so on, and we'll figure out whether to go for 1100 tons or what the project should be, and we will come back to you after that.
Okay, got it. The third question is that we had a tough year in Germany due to energy crisis, etc., which has also impacted our margins over there. So has the situation normalized in Germany? And if yes, then how much margins can we expect from Germany plant in normalized situation?
So there are two sources of energy that we use in Germany. One is natural gas, and the other is electrical power. So the prices of natural gas have stabilized significantly to what they were before the war started. And to that extent, it gives us some comfort that the prices have stabilized. However, the cost of electrical power is yet very high. So that I believe is based to a large extent on natural gas, and therefore I would imagine that the price should be coming down in the foreseeable future. But till that time, I would say that power prices still remain high. I see that the working this year would definitely be better, more improved as compared to last year, which was quite a disastrous year, frankly.
Okay, sir, got it. But in the normal situation, can we make around 20-25% margins what we make in India, in Germany?
That would be difficult to make in any overseas operations, particularly Europe and Germany. So we believe that 10 to 15% will be normal margin for that business there.
Understood. Thanks a lot, sir, and all the best for the coming years.
Thank you.
Thank you. Ladies and gentlemen, if you wish to ask any questions, please enter star followed by 1 on your phone. The next question is from the line of Ranganath N, an individual investor. Please go ahead.
Hi, sir. Congrats for your acquisitions. And it seems like I have few questions on the acquisitions part. One is how are you planning to fund this acquisition and capex plans going forward? Is there any chance of equity dilution going ahead?
So we already funded the acquisition, paid the money, and now we are incurring capex. This is 34 million euros, and out of that 24 million is being borrowed from banks, which is already tied up. The remaining money is funded from internal accruals of the company.
So there is no equity dilution chance going forward?
There is no plan for that particular leg. Whenever we have more capex plan for expansion, that time we'll be raising equity.
Okay, thank you. So my second question, you said there is an anti-dumping duty request that you put in for government. So how is that, response from their side? Is it positive, or do you expect anything in future?
So anti-dumping duty has been discontinued from 17th August 22, though Commerce Ministry had recommended, but Finance Ministry declined it. So there is no anti-dumping duty. That chapter is over. If we want the anti-dumping duties to come into play, we will have to file the application again for every country like China, Vietnam, and Malaysia, and then the entire process will be run, which may run up to 1 year or so, after which one can expect anti-dumping duty.
So if I correct me if I'm wrong, my understanding, I heard we already filed an application for that. Is that not the case, or are we still in the process?
No, we had filed application for continuation of anti-dumping duty against China, which was expiring in August 22. Okay. The DGTR analyzed everything. They held the entire process, and after that they recommended anti-dumping duty continuation for 2 years. But Finance Ministry declined it. So that matter is over now. If we want to invoke anti-dumping duty on any of those countries, we'll have to file fresh application now.
Okay. Thanks, sir. And we're looking forward for your profit margin increase. Thanks for taking my question, sir. Thank you.
Thank
you.
The next question is from the line of Nikhil Abhyankar from ICICI Securities. Please go ahead.
Thank you, sir. Thanks for the opportunity. So, sir, my first question is, what is the share of solar glass in the total cost of a module?
So it actually depends on which kind of module you are talking about. If it is conventional module where you use glass in the front and back sheet, polymer back sheet at the back side, it would be 8-9%. If it is a bifacial, then it might be 15% also.
Okay, if is a bifacial. So my second question will be, among the PLI winners who will be ramping up their module facilities, so what portion of them are getting into these bifacial module manufacturing?
So basically all the solar cells now being available are bifacially charged. You could eventually make bifacial modules from every cell available now. But it all depends on what kind of applications and what kind of projects you are doing. So if you talk about international scenario like China, already almost 45-50% is bifacial module. But it is yet to be followed in the same way in India and Europe. So gradually it will move higher up in the bifacial modules as we go along, because earlier the equipment were not capable of making bifacial module in India and so also in Europe, but now they are changing the equipment, and gradually there will be increase in the bifacial module.
Okay. And so are we in talks with any of these PLI winners or are they in talks with us for getting into any kind of a long-term supply contract?
Actually, most of these people are our customers already, and those who are not also, we are in touch with them. And the contracts practically have not worked so far, like long-term contracts, but supply arrangements on a monthly basis are there. And we hope to continue like that, because without the price, there is no contract basically, and price is something which nobody wants to prefix because of the changing situation. Well, like the solar glass prices keep changing, every component price keep changing, and the dynamics of profitability keep shifting from here and there in the module industry. So nobody wants to have a fixed price. But basically, all the people who are going to have module capacities will require glass, and higher the domestic value added is there, they will be getting higher PLI. Yeah. So obviously, it will be interesting for them to buy locally.
And so they are not looking to set up their own glass manufacturing facility.
Well, Adani and Reliance are looking to set up their own capacities, and also maybe like Shirdi Sai Electricals might look at setting up the capacity. Other than these, we have not heard any other player looking at setting up glass capacity.
Okay. So just a final question. So what is the difference in realization for exports and domestic sales?
So export realization is higher compared to domestic realization by about...
I did not get you. Can you please repeat?
Export sales realization is higher compared to domestic realization by about 10-12%.
10%. Okay, sir. That's all from my side. Thank you and all the best.
Okay.
Thank you. The next question is from the line of Santosh Kucheria, an individual investor. Please go ahead. Santosh, your line has been unmuted. Please proceed with your question.
This is with regard to inventories in asset and liability statement. 174 crores of inventories is there. In which how much is the finished goods and how much is the raw material?
Suhil, can you respond on this?
Yes, sir.
Or you want to come back? In the meantime, we can continue with another question.
Yeah, and this is with another profit and loss standalone results. The power and fuel was last year it was 30 crores, now it is 52 crores. Why is so much high this?
So now we are running third furnace as well, which is a large furnace of 550 tons per day. So we need to have more power and fuel consumption. From 450 ton, we have reached 1000 ton production. So obviously it will require power and fuel.
But it has not reflected in your turnover because the production has gone up from February itself. So the revenue should have been high. Whether you have billed or not, it has been shown in under inventory then.
Yeah, so commercial production is begun on 23rd February. So virtually 1 month production has happened in March. And there has been some build-up in the inventory as well, which is why the ratio is not appearing the same.
So actually, whatever you are producing, those goods are not getting sold or you are invoiced, but the goods have not delivered like that.
So there are two things. One is that India's impact is there, large impact is there of goods having been invoiced but not delivered to the customers. So that's a large impact already. Plus there was some build-up in the inventory as well, because initially when you start producing, you don't get 100% right material. So one is to see for a 1 month, 2 months or so before it can sell everything.
So just to clarify on that 174 crores of inventory, how much is finished and how much is the raw material? Because you have debited all the raw material expenses in profit and loss account, I think, consumed raw material.
Yeah, Rumta.
Out of 174 crore inventory, sir, 74 crore inventory is raw material.
Yeah.
And balance inventory of finished goods, work in progress, stocks, packing material, and collect.
So have you invoiced out of the 100 crore? Have you invoiced anything? But the goods are not delivered to the party.
That is 36 crore around.
Means 36 crore you have sold, but it has not happened sold, right?
That is in stock because of India's.
Yeah. Otherwise, profit has been much more than that figure. No?
Yes.
Right, thank you.
Okay.
Thank you.
Thank you. The next question is from the line of Rishabh Shah from Dalal & Broacha. Please go ahead.
Thank you so much for giving me the opportunity to ask the questions to the management. I have a few questions regarding the company, understanding the company. So, will the management can tell me or have a brief idea about what will be the realization number for 1 mm glass that is imported from China in India?
Yeah, we obviously have an idea about what prices the goods come in India. And in fact, the goods are sold by us taking benchmark of import prices. So obviously we need to know that. But each and every buyer has different pricing. On an average basis, the goods, if you were to ask me on a per millimeter basis, it will be about 110 to 115 rupees per millimeter.
Okay, thank you. My next question would be regarding for the third furnace. So the third furnace would be a dual furnace. If you know the dual furnace where in the previous conference calls or in previous investor presentation, it was mentioned that it's run on furnace oil and on the diesel. So will that be a dual furnace?
Yes. It will be a multi-fuel furnace. It can be run on different sources of energy. It could be natural gas, could be furnace oil, diesel, LDO,
Okay.
propane, LPG.
Okay. Now my next question would be regarding the number of days for the production of the glass, which is your capacity is 1350 ton per day. So for on yearly basis, if I want to calculate on a yearly basis, so for how many days shall I take for the calculation for yearly basis of the production?
You take the entire full year, but generally 10% would be downtime for the roller change and other things. So generally 330 days is what one can take.
330 days, which I heard?
330 days.
Okay. And okay. And also, can you please give me any update for the ADD by the government, which that is ADD that is going to be imposed on China by the government? Is there any update on that?
I wish I would love to give you that update, but this is completely beyond our scope. We have been trying very hard, and we are hopeful that we should succeed because we have very good reason for our request for grant of basic customs duty, at least, if not anti-dumping duty. And it's a question of when the government will sit up and take notice.
Okay, sir. Thank you. Also, I just have one question regarding the 67 gigawatt solar production, which was reported as of FY23. So, do we contribute 100% to it? Do the solar glass contribute 100% to it?
No, not at all.
No. This installation can be by way of domestically manufactured modules or by imported modules. So a large portion of the installations in the past have been with the imported modules. So it will be incorrect to say that it is made in India or like that, and we contribute for the module making. The domestic module manufacturing, of course, is going up now. So as we speak, the domestic modules, maybe about 75% of the installations currently happening.
Okay. Thank you, sir. And sir, also I would like to ask that can you please tell me how much would be the export volume, if you can give me some guidance towards that?
Exports are about 25% of the volume.
25% of the volume. Okay, sir. Thank you. And thank you very much for answering the questions, and I hope the company prospers in future. Thank you very much.
Thank you.
Thank you for your wishes.
Thank you. The next question is from the line of Sagar Sanghi from ADD Capital. Please go ahead.
Yeah, thanks for the opportunity, sir. I have two sets of questions. One on the volume front. Sir, at 1350 tons per day, what would be the full utilization that you would be looking at in terms of percentage? And at full utilization, what kind of volume should be looking at in terms of square meters, or any volume metric that you can help us understand so that we can model a PNL for that? That is one. And two, on the raw material front, how should we look at raw material prices going ahead in terms of soda ash prices? Do we have the contracts for the full year or half yearly contracts? And even on the other raw materials and power and fuel.
So on the production side or turnover side, the one benchmark to take would be that if you were to run both the plants full capacity like India and Germany, the turnover which one can expect could be about 1800 to 1900 crores per annum in rupees terms.
No, sir, I understand. But that will also take a particular realization per square meter or something into consideration.
Yeah, so that's the reason I have given you a band of 1800 to 1900 crores, depending on what the price would be and what the volume we can expect. In terms of the quantity, if you were to ask me, from Indian operations, one can expect about 5 crore square meters, 0.2 millimeters.
Okay. And
the German operations about 1.1 crore square meters, 0.2 millimeter.
Okay. On the
with regard to your other question on the cost and prices, we do have supply contracts for soda ash for this calendar year, and this time the contract is on linked to benchmark of quarterly pricing. So should there be any changes in the quarterly pricing, it will be applicable to us from the next quarter. So suppose the price in this quarter is
Got it. With a lag effect.
with a lag effect, yes.
Got it. About other fuel?
For power and fuel, like power, of course, is like Discom, and now we, of course, have our own power. And fuel we are buying from the government-owned companies, and natural gas coming from GAIL.
So what would be the margin should we be looking at? Is it 22% margin, or will it be a normalized 15-16% kind of margins for the consolidated numbers?
So our margins in last 3 years have not been below 20%. So it is not right to assume 15% margin. But we expect margins to be between 20% to 25% generally.
On a consolidated basis, not India operations, right?
Standalone, I'm saying.
No, my question was on the consolidated basis.
On international operations, we see margins to be between 10 to 15%, so one can do the console.
Got it, sir. Okay, fine. Thank you. Thanks a lot, sir.
Thank you. The next question is from the line of Anuj Upadhyay, an individual investor. Please go ahead.
Yeah, hi. Thanks for the opportunity. I'm from Invest sector, not an Indian journalist. Anyway, sir, you mentioned about the market share, domestic market share declining to 19%. Can we throw some kind of a number on the export market? I mean, what share do we have? No, China has a major role to play out there. But any market share which we can figure out for ourselves over there?
So there are different markets in which we have different market shares. So it is not uniform like Indian market. Of course, we can discuss about the market share, and we may not have complete idea of other markets as well. So like we are through our German operations, we know that we have a large market share there. Our German company is holding almost 60% to 65% of the market in Europe. We have another 10-12% there. So that's the market share we enjoy there. In Turkey, we may be about, again, 10-15%. And in USA, we are hardly there, maybe 1 or 2%.
Okay. So this export which we are doing is largely targeted towards the European region, or goes to
Europe and Turkey.
The European sorry, sir?
Europe and Turkey.
It's Europe and Turkey. And going ahead, sir, considering the fact, that the domestic competition is going to be intense, what would be our strategy in the export domestic competition? So the focus would largely be on the export market, or how things going to pan out?
Yeah, we maintain our focus on the export market, subject to the limitation of growth there sometimes. But of course, we'll have to increase our presence in the domestic market as we grow the volumes, because the demand and the module manufacturing activity in India is growing very fast as compared to other countries, other markets. But maybe after 1 or 2 years, USA will become another growth area. But as of now, we concentrate on Turkey, Europe, and India.
Okay. And sorry, sir, I joined in a bit late. So I missed out on your Q4 production and sales volume, and also the bifurcation among the domestic and export sales. Can you please help me out with this?
So the sales volume has gone up by about 7-8% in the quarter, led by the commissioning of SG3, but it has not got a full operations as of now. We started only from 23rd February. So from the current quarter, the impact will come in a major way, and then it will show a right picture.
Right, sir. And the export and domestic mix?
Well, it was about 25-26% in export in the last quarter.
In the last quarter. Okay. And so our earlier agreement on the soda gas got expired in December 22, and we have now entered into a new contract. This is in what time period, and how much is the elevated prices compared to the previous contract?
So we are still waiting for the right level of the prices for a new contract, but in the meantime, we are using a major part of our operations furnace oil, which is cheaper than the market-related gas as of now. And market-related gas prices also have come down, but they are still way above furnace oil prices. When they are almost at same level, we'll like to enter into contracts.
Fine, sir. So the likewise in Europe, even in India, we are using furnace oil, right, sir?
Sorry, say again.
Likewise in our European operation, even in domestic market, we are using no furnace oil. This is what you are saying?
No, in Europe, we are using completely natural gas and oxygen and like that. There is no use of furnace oil in European operations. In India, almost about 18 to 20% is the utilization of gas and rest is furnace oil. So that's the mix right now in India. But as and when the prices of gas are right, we will again shift back to gas.
Right, sir. And with the commissioning of this 10 megawatt captive power plant, any rough figure you can mention, sir, how much are we saving on the power cost? Or how much we could save, say, with the full commissioning of the existing station?
We hope to save about 35 to 40 lakhs per month.
Okay. And lastly, sir, in opening remarks, you did mention about we are rethinking on the strategy of coming up with the LC4 and LC5. When we have a discussion on this expansion, you had mentioned all our clients with whom we have a contract to supply the solar glass, or to whom we do supply. Majority of them are going for the expansion plan on the module manufacturing. So the reason to relook at the strategy has to do with the intense competition, because demand, I don't think so, is a concern as of now. It has to do with the price. Am I right in my assessment, sir?
Yeah, so we are currently in the process of stabilizing our expansions, because after having expanded from 450 ton to 1350 ton, we need to take a pause, and we cannot be in a hurry. And similarly, there are other aspects like on the duty front, there is no clarity as of now, and we cannot only chase the revenue and not the bottom line. So we would not like to sacrifice too much on the bottom line and just chase the growth. So we will take the call at opportune time when to put in money for the next expansion.
Fair point, sir. And lastly, sir, if at all we supposedly decide to go ahead with this expansion in next quarter, how much time will it take, sir? Because earlier target was to set up this capacity by FY26. So we will be sticking to the same timeline, or there could be some kind of postponement?
18 to 24 months. Yeah, it takes about 15 to 18 months anyway, and whenever we take the call from there, it can be another 18 months, you can say.
Thank you, sir. Thanks for answering my question.
Yeah, thanks.
Thank you. The next question is from the line of Rishabh Shah from Dalal & Broacha. Please go ahead.
Hello. Thank you very much for taking my questions again. One of the questions which I have is for the backward integration that the company had given the guidance for soda ash and natural gas. Are there any updates on the backward integration for that?
No, we do not have any such plans. We have never given guidance to get into backward integration of these products. So I think you seem to have misplaced.
Okay. Okay. And also, I just have one question regarding, are there any differentiation in the quality of glass that is produced by us and the glass which are imported from China, Vietnam and Malaysia?
Generally, the quality is same.
However, our quality, there are some differences in composition which gives our glass greater longevity, which we do because we believe in making a better product.
Okay. Okay, sir. Thank you very much. And thank you for having me on the conference call. Thank you.
Thanks.
Thank you. Ladies and gentlemen, if you wish to ask any questions, please enter star and 1. The next question is from the line of Shirish Jain, an individual investor. Please go ahead.
Hi, good afternoon. My question is pertaining to the capital allocation policy. Now, in the absence of a big capex in the ongoing year, what will be the capital allocation policy regarding the free cash flows?
So we are continuously innovating and continuously looking at various opportunities in the business. We have recently started R&D center also in Pune with an objective to develop products or come up with cost saving measures and all. Whatever cost saving measures are there, they may not require large capex, But in case we are able to come up with some new products, new ideas, we will discuss that, and then we can come back with the plans to do any capex on that. So in the meantime, the small capex or routine capex we will continue to do.
No, so my question was whether the free cash flow that we generate this year, whether we will save it for the capex that is upcoming in next year, or whether we will use it to reduce the debt or a possible dividend payout. What are the management's thinking on this?
So I think we will take the call at appropriate time. Right now we are not in a hurry to decide on that, and our next expansion may not be very late as well. So maybe most probability the cash flow will be used for next capex cycle, but we'll have to take a call as and when we reach that level.
Okay, understood. I have just one more follow-up question. So always our exports were very high margin products for us. Now that we have a European subsidiary, where is the material that we are producing in Europe is being sold versus where were we exporting from the Indian manufacturing houses?
So material produced in Germany is getting sold almost 100% into European market only, whereas we have been exporting to Europe, Turkey, USA, MENA countries, and all the areas where the demand is there. So that's how it is being looked at. Currently also we continue to export material from India to European market because there is a higher demand for glass, which the German plant cannot completely meet.
Okay, understood. So none of our exports are being sacrificed because of this European plant, right?
No, because they contribute only 60% of the market, and there is room available for other players to supply. So we continue to export.
Understood. That's all from my side.
Thank you. The next question is from the line of Jiten Rishi from Axis Capital. Please go ahead. Jiten, request you to please unmute your line and proceed with your question.
Yeah, thank you for taking my question. My first question would be on the Europe business. As you said, that plant has the capex is done and plant has settled down. So what could be the contribution from the European plant in terms of total revenue this year probably, or what is the order backlog? Or because you said utilization level can be at 80% plus if at all, and there is a room for huge scope in the European market. So what can we see? Any guidance this year for the European business from the German plant?
So we can probably expect a turnover of about 550 to 600 crore from that plant.
And so this margin would be like 15-20% from the
10 to 15%, yeah. EBITDA margin.
And so this 550 crore is like the peak, or we can even achieve more?
Well, we have just rebuilt the furnace, and we will have to build up extra production and get in efficiencies and all. It could be slightly better, but this is what we normally expect when we start the production. As we go along, we will try to improve our productivity over there.
So, what will be the portion of exports to the location with anti-dumping duty against China, and probably how competitive are we in those areas? Like probably I know that your main export is in Europe and Turkey, but how are we competing with China in those regions if there is an anti-dumping duty there?
So in both these markets, there is anti-dumping duty against China, but there is no anti-dumping duty against Malaysia and Vietnam, who happen to be the large exporter to these two geographies as well. And we have to compete with them.
And these entities are also like Chinese company only from Malaysia?
Yeah, they are Chinese company only.
Okay, sir, that's it from my side. Thank you, sir, and all the best.
Thank you.
We have a follow-up question from the line of Shresh Jain, an individual investor. Please go ahead.
Sir, one question. So in the earlier calls, we have suggested that 1,000 TPD plant would help generate 1,200 crores out of revenue, which indicates to 1.2 times asset turn. But in the previous question, you suggested that a 350 tons plant could generate 500 crores of revenue, which is much higher asset turns. So is it the case that the European plant are much better in terms of efficiency and productivity?
No, in fact, the prices in Europe are higher compared to what they are in India. and it can generate a better product mix as well, because there are a lot of markets which they serve, like greenhouse or bifacial markets which are paying higher amounts there. In Indian context, we have to compete with Chinese and our prices remain lower. So that also is another bottleneck in India.
Okay. So, sir, regarding Indian manufacturing plant, 1.2 times asset turn is still an ideal situation.
Is it 1.2 asset turn is happening because ours is a greenfield, brownfield expansion here, and we had set up the old plants like say 2010 and 2019 and all. But if it was a new plant to be set up in India, the asset turn will not be like that. It will be mostly 0.85 or like that. So in Indian context, for our company, you can say it will be 1.2 times, but if you have to really look at any greenfield plant, it will be much less than 1.
Okay, that's very helpful. Thank you so much.
Thank you. As there are no further questions, I would now like to hand the conference over to management for closing comments.
Thank you very much for your questions. These have been, they reveal the interest that investors are taking in the stock and in the operations of the company. I can only assure investors that we continue to remain alive to the situation, and we are constantly working towards making products that would have a higher realization. We are also working constantly to maximize production and also to keep our costs at the lowest possible level. I do want to inform people that what we have done now is we have installed a very modern, very sophisticated plant, and it just takes time to tune it up and to get the maximum output from this. So we're hard at work, and we are seeing results every week. Things keep getting better. So we are quite confident that in time we should be able to cover all the points that need to be covered, and we should be able to have very efficient production from the total operation. Thank you.
Thank you. On behalf of Axis Capital Limited, that concludes this conference.